Welcome to the OECD's presentation of the economic outlook for the world economy, with a special focus on Southeast Asia. At the end of today's discussion, we will have a question and answer session. If you have a question you would like one of our experts to address, please add it to the chat. Today's event will be structured into 4 parts. There will be the global outlook presented by Isabel Casque, Deputy Director of the Economic Department's Country Studies Branch. The regional outlook for Southeast Asia will be presented by Jens Arnold, Head of our Southeast Asia Division. Next, we will have the economic outlooks for the countries of Indonesia, Malaysia, the Philippines, Thailand, and Vietnam, presented by our senior economists Cyril Schwellnus and Philip Hemmings, followed by the question and answer session. Now, I'd like to turn the microphone over to Isabel Casque.
Thank you very much, Laura, for this introduction, and a warm welcome to everyone also from my side. Well, the title of our outlook is Under Pressure. That's not just rhetorical, it really precisely captures where the global economy stands today. Over the last 5 years, the world economy has shown remarkable resilience, absorbing a pandemic, an energy shock back in 22-23, and also the fastest increase in interest rates in a generation. And now the conflict in the Middle East is putting renewed pressure on the global economy with near closure of the Strait of Hormuz. As a result of the conflict, as you can see here on this slide, energy prices have spiked. Brent crude rose to $118 per barrel in late April, the highest level since 2022. And it has remained above $90 for nearly 3 months now. Diesel and jet fuel prices are around 50% higher than before the conflict, which of course pushes up transport, aviation, and freight costs all across the globe. Next slide, please. But the surge in commodity prices extends well beyond energy, as you can see on this slide. Prices have risen by up to 55% for a range of non-energy commodities, which of course means high costs for fertilizers, digital technologies, automotive components, and also for chemicals. Next slide, please. The exposure to energy imports from the Middle East varies quite a bit across countries and also across sectors. And this reflects differences in both the direct use of energy from the region and also differences in countries' indirect exposures via underlying supply chain linkages. Many Asian countries are amongst the most exposed, including Thailand, Korea, India, and also Japan, which are to the very left-hand side of this chart. Next slide, please. Inflation, which had been on a clear downward path prior to the conflict, has now turned and is rising again. Since February, price pressures have risen in many countries, including the United States, the Euro area, South Africa, Brazil, and also India, as you can see here on these 2 charts. Government support measures, price caps, subsidies, and tax reductions, they have contained some of the increase, but still around 1/3 of OECD economies will see negative real wage growth this year. Next slide, please. There's important countervailing force in this overall picture. AI-related investment is providing momentum that partly offsets the drag from higher energy prices. Industrial production of computer and electronic products is substantially outpacing that of total industrial production, as you can see here in this chart. But this positive force is not insulated from the Middle East shock. For instance, the production of semiconductors relies heavily on helium, a big chunk of which originates in the Middle East. Moreover, energy accounts for around 6% of the operating costs of data centers. A prolonged conflict would thus not just weigh on growth through higher energy prices, but it would also constrain the investment in AI that has been the main engine of growth over the past quarters. Next slide, please. Given the high uncertainty surrounding the extent and also the duration of the conflict in the Middle East, we are presenting 2 alternative scenarios in this current economic outlook. A first scenario, which is depicted here by the green lines, assumes that energy prices gradually ease from the middle of 2026 onwards, which is broadly in line with current futures market expectations. In this scenario, oil prices averaged $92 per barrel this year and $80 per barrel next year. In this scenario, we project global economic growth to slow from 3.4% in 2025 to 2.8% in 26, and then to recover to 3.1% in 27. That is 0.4 percentage points lower for 26 when we had projected prior to the conflict. Average G20 headline inflation is projected to rise from 3.4% last year to 4% this year, and then to ease to 3.1% in 27. However, should disruptions persist well into 2027, that's the second scenario, the red lines here on this slide, global growth is expected to slow much further to 2.1% this year and then to 1.8% in 27, potentially pushing some economies close or even into recession. In the second scenario, oil prices would average $115 per barrel this year and $119 per barrel next year. G20 inflation would rise to 4.4% in both years in this scenario. Unemployment would rise as well. And investment, including in energy-intensive AI, would weaken significantly with increasing risks for financial market repricing. Next slide, please. On this slide, you can see our detailed projections for GDP for the G20 economies. I don't want to go, through all the detailed countries because my colleagues will do that later on for Southeast Asia. But I would like to focus on the red bubbles with the little minuses. These red bubbles indicate major downward revisions by 0.3 percentage points or more compared to the outlook that we've published in December last year. And as you can see, for the G20 countries, we have revised down growth by 3 percentage points or more for 8 economies in 26 and for 3 economies in 2027, showing the significant impact of the energy shock. Now let's move on to the non-G20 economies on the next slide. Let me again focus on the red bubbles. Here you see that we have significantly revised downward our projections for 16 out of 26 countries for 26, which means a much higher share than for the G20 countries. And the question, of course, is why is that? Well, ultimately, smaller and more open economies are more sensitive to a global energy supply shock. They have a higher reliance on imported energy and also are more specialized in their domestic economic structures. And as a result, global prices tend to feed more rapidly into domestic growth and inflation. Next slide, please. This outlook is surrounded by significant uncertainty, and the risks are unfortunately predominantly to the downside. The first risk I would like to mention relates to fertilizer prices and food security. The near closure of the Strait of Hormuz is squeezing fertilizer markets, and prices have risen close to their 2022 peaks, as you can see here on this slide. Our estimates suggest that a sustained 47% increase in fertilizer prices, which is roughly, the current market conditions, would raise agricultural commodity prices by around 8% next year. That's not an abstract risk. It's a clear food security risk, and it will fall the hardest on the most vulnerable countries and also the most vulnerable households within these countries. Fiscal risks are also rising, as you can see on the next slide. Since late February, sovereign bond yields have increased across most economies, with pressure more pronounced on shorter maturities. This means that governments are facing more immediate increases in financing costs, which limits the fiscal space to respond to the current shock. Another important risk relates to trade policy, which is on the next slide. The effective tariff rate on United States merchandise imports was around 10% in April, down from around 18% a year earlier. This reduction has been positive for trade and growth and is one reason why underlying momentum was stronger than expected before the conflict broke out. However, uncertainty remains high. The 10 percentage point tariff introduced by the US following the Supreme Court's ruling on the International Emergency Economic Powers Act is due to expire in late July unless Congress decides to extend it. How this is ultimately resolved is highly uncertain, but will of course matter a lot for the economic outlook. Let me now also mention one risk that is an upside risk and could actually affect growth in a positive way. Next slide, please. And this positive risk is also ultimately related to the strong optimism we're observing around artificial intelligence. As you can see on the left-hand side panel, there's little sign that the momentum in this sector is slowing. Planned investment by major AI companies for this year and next year is expected to be almost double that of 25. The potential economic gains are large. OECD estimates shown on the right-hand side panel suggest that broad AI adoption combined with complementarities with traditional software could raise annual real GDP per capita growth in most G20 countries by more than 0.4 percentage points and by up to 0.9 percentage points in the United States. If these benefits were to materialize, AI investment and also associated productivity gains could represent a major important upside risk to the economic outlook. However, as I mentioned earlier, a continuation of this strong AI momentum cannot be taken for granted, especially not if the current supply chain disruptions persist, given that the industry also depends a lot on products exported from the Middle East. Let's now move on to the policy priorities. The first one I want to mention is monetary policy. Central banks are obviously facing a very difficult balancing act. If inflation expectations remain well anchored, they can look through a temporary supply shock that only increases headline inflation due to higher energy and food prices. As shown on this slide here, shorter-term inflation expectations have moved higher, reflecting the recent increase in energy and food prices. However, longer-term inflation expectations remain broadly stable to date. This suggests that markets and households expect inflation to return towards central bank targets over time. Nevertheless, central banks may have to intervene, especially if price pressures prove more persistent or spill over more broadly into underlying inflation. On the fiscal side, that's the next slide. The constraints are actually tightening. Total public debt in the OECD reached 111% of GDP at the end of last year, up from just 74% back in 2027. Spending pressures from population aging, debt servicing, and also rising defense requirements are all pointing in the same direction, meaning higher spending pressures. Stronger efforts are therefore needed to contain and reallocate spending, improve the efficiency of the public sector, and also enhance revenue-raising potential, while at the same time preserving potential growth, which of course is also very important for the reduction of debt to GDP ratios. Next slide, please. In response to the energy crisis, governments across the globe acted swiftly and rolled out a range of measures to support households and firms and to shield them from the higher energy and other prices. So far, most support measures have focused on reducing energy prices directly through the tax system or through subsidies, given that such measures are faster and easier to roll out and also have higher visibility than more targeted measures, and for this reason make them politically more attractive. However, targeting is very important. For instance, lower-income households spend a larger share of their income on energy, and rural households may have less means to adjust, for instance, their transport patterns. And SMEs, for instance, have less liquidity to weather a shock than large companies. As such, targeted measures at those firms and those households that are very vulnerable would allow for better protection of these firms and households, while at the same time be less fiscally costly. Another key lesson that can be drawn from the previous energy crisis and is also relevant for the current one is to ensure that support measures, no, please move back, is that support measures are temporary. As energy prices normalize, they should be phased out as soon as possible to not impede structural change and also to limit the fiscal costs. And finally, support measures should not distort price signals, or at least distort them as little as possible, so that incentives for energy savings and for investments in energy efficiency are maintained as largely as possible. Measures such as tax reductions, subsidized prices, also regulatory price caps, and also export restrictions, all those measures on the left-hand side of this graph, they do very little, in fact, to encourage energy savings. Now we can move on to the next slide. Another important policy message is that countries need to continue to reduce their vulnerability to future energy price shocks by diversifying the energy mix further. Countries have already moved in that direction during the last energy crisis, but nonetheless, renewables accounted for just 6% of total energy supply across the OECD between 2019 and 2024. So there's great potential to move further in this direction. Next slide, please. Open markets and rules-based trade are among our most powerful tools for building resilience. And yet, import restrictive measures are expanding rapidly across the globe. New restrictions introduced since 2019, as you can see here on this slide, now affect an estimated 19.7% of world imports, up from just 3.1% back in 2016. That is a six-fold increase in less than a decade. New export restrictions in response to the supply disruptions caused by the current conflict should be avoided, as they only exacerbate global supply shortages. In contrast, what we need is a constructive dialogue that makes the trading system fairer and more resilient while preserving the benefits of openness. This is the only really durable answer. Last slide, please. Before I hand over to my colleagues, let me quickly summarize, the main messages. First of all, the conflict in the Middle East has become the dominant force shaping our global economic outlook. We now expect weaker global growth, high uncertainty, and also a more challenging economic environment more generally. And obviously, the longer the disruptions last, the greater the economic and social costs, and also the more challenging the policy trade-offs that policymakers need to manage. With that, let me thank you for your attention and now hand back to Laura and then my other colleagues. Thank you.
Thank you, Isabel. Next, we have Jens Arnold, who will present the regional outlook for Southeast Asia.
Okay, thank you very much, Laura and Isabel. So on the next slide, we see that in our time-bound disruption scenario, growth in the 5 Southeast Asian economies that we are monitoring closely is set to dip in 2026 before rebounding in 2027. We have a weighted average growth of 4.2% in 2026 for those 5 countries, followed by 4.6% in 2027. Growth in the region is still substantially higher than in the OECD, as we see on this chart, and roughly in a similar ballpark range to growth projected for China. Now, on the next slide, we see our prolonged disruption scenario. So the difference here with respect to growth and inflation for the different world regions that have been analyzed in this scenario is largest for Southeast Asia. So Southeast Asia would be harder hit than any other region in the world if supply disruptions were to last longer. For inflation, longer disruptions would also imply a higher likelihood that fertilizer shortages or difficulties in importing food fuel food inflation. And here we have particular vulnerabilities in the region. The Philippines and Thailand are particularly exposed to this, given their dependence on imported food and fertilizers, while Indonesia is much less vulnerable in this regard. Food price inflation would transmit probably more easily into core prices and is hence more likely to force monetary authorities to tighten financial conditions. On the next slide, we see that within Southeast Asia, there are considerable differences with respect to how vulnerable the different economies are. Thailand is highly import dependent, but it also maintains higher inventories than other countries in the region. Malaysia is a net exporter of gas, but it imports crude oil and petroleum products. Indonesia has some gas exports, but certainly a lot of exports of coal. In a nutshell, the trade flows suggest that there are stronger vulnerabilities in Thailand, Vietnam, and the Philippines among those 5 countries in the region. In the next slide, we see that in all 5 countries, except for the Philippines, we see more targeted policy measures in response to the crisis than targeted ones. So the bulk of this is often energy price support, which tends to be costly and provides supports to households who may not actually need it, while at the same time weakening price signals to reduce energy demand. Subsidies should only be the last resort. And among the targeted measures here that we see, only the Philippines have been able to resort to targeted income support. On the next slide, we see that the rising energy prices, the rising global oil prices, which are depicted in the dashed black line here, have not always translated into higher energy prices domestically. So we see that higher global oil prices have translated into higher energy prices in the Philippines and in Thailand, but not so much actually in Indonesia, Malaysia, and in Vietnam. When countries want to move from untargeted support to more targeted support measures, what they need is targeting instruments. And on the next slide, we see that countries in the region have actually made progress towards building up social registries, which are the prime instrument for delivering targeted support. We show on this slide a few examples of registries and programs that targeted support measures could build on. So progress is clearly not complete, but the emergence of these social registries gives hope for moving forward towards more targeted income support to respond to crisis situations like this one in the future. On the next slide, we see the fiscal constraints that the region is facing. In fact, targeted income support is much more efficient and less costly than broad-based measures. And this is particularly important in the context of the limited fiscal space that is prevalent across much of the region. So we see that all of the 5 countries here had sizable fiscal deficits in 2025, which are only projected to become larger in 2026. On the next slide, we see that public debt is also high in some countries, notably in Thailand, Malaysia, and in the Philippines. And future spending pressures from population aging, from the need to increase and improve social protection, and from the energy transition call for rebuilding fiscal space rather than reducing it at the current juncture. On the next slide, we see that inflation has been largely contained in the region, admittedly more so in countries with energy price support. Our inflation projections show significantly higher inflation in 2026 than in 2027, again for the time-bound disruption scenario, particularly in Thailand and in the Philippines. But countries in the region have also made progress in anchoring inflation expectations and building up credibility of their monetary policy frameworks. So temporary rises in inflation will create less worries than in the past. Many central banks in the region can actually see through this supply shock, at least when the disruptions do not last too long. On the next slide here, we see that, as Isabel said, one lesson that emerges from the current crisis is the need to accelerate the rollout of renewable energy. This would enhance energy security and resilience to future price shocks. And what we see here that the region has actually made some progress in this regard. Vietnam has now exceeds the OECD average with respect to the share of renewable energy sources, while other countries in the region still have scope for further expanding renewable energies. On the next slide, we will now turn to trade, which is the other important issue for the region. Despite tariffs and uncertainty, export growth of the ASEAN 5 countries has actually remained buoyant, and this is true with respect to exports to the United States, to China, but also to other countries. So what are the prospects for trade and trade policy? On the next slide, we see that the answer here is a combination of lower tariffs right now, but high uncertainty about the future. The black line that we see here is the currently applied 10% tariff under Section 122, which currently applies to most items. The red corridor is the main tariff rate under the different bilateral agreements that countries in the region have negotiated with the United States. These exceed current tariffs, and that may cast doubt on what the value of these agreements will be in the future. Effective tariff rates, which are the multicolored lines that we see here, differ with export profiles due to sector-specific exemptions, and they are currently scattered around the current 10% tariff rate. Now, what Section 301 reviews will bring in the future is, of course, everyone's guess, but we've had a peek preview of the potential uncertainty that this could bring over the last few days. On the next slide, we see that trade has also been a positive force for exports and growth in the region, notably in sectors related to artificial intelligence. Imports from Southeast Asia from these sectors have risen sharply to the United States and have become ever more relevant. And on the next slide, we see that this has also triggered strong FDI inflows into these sectors in Thailand and Malaysia, as we see in this chart. And with this, I will hand the floor back to Laura. Thank you.
Thank you, Jens. Next, we will have Cyril Schwellnus, who will speak about Indonesia.
Yes, thank you, Laura. So Indonesia ended the energy crisis on a very firm footing. Real GDP growth was strong in the first quarter, expanding by 5.6% year on year. Household consumption and investment held up, also helped by earlier monetary policy easing. But now we see momentum moderating. Retail sales have normalized after the religious holiday boost in the first quarter. Consumer expectations have softened, and we also see some weakening of manufacturing activity. So our near-term outlook is cautious. We expect growth to slow to 4.7% in 2026 before rebounding or recovering to 5% in 2027. And this cautiousness reflects, as highlighted by Isabel and Jens in their presentations, headwinds from higher energy prices, also headwinds from monetary tightening, and weaker export demand. Regarding inflation, this remains relatively contained in Indonesia for now. Headline inflation is creeping up, but it remained within the central bank's target band at 3.1% in May, partly because the freeze of subsidized fuel prices. But higher global energy prices and the depreciation of the currency, the rupiah has depreciated by 6 to 7% since the beginning of the year, are expected to gradually pass through to domestic prices. Bank Indonesia has already responded to these risks by raising its policy rate by 50 basis points in May. We do not expect further rate increases this year. But despite this monetary policy tightening and the fuel price freeze, we think that pressures from the exchange rate and higher energy prices are going to raise inflation to 3.4% this year. So very close to the upper ceiling of the central bank's target bank. Turning to structural reforms, we highlight two reforms that are critical to preserve fiscal buffers and support growth. First, we highlight that Indonesia could improve the targeting of energy subsidies. As you can see on the slide, the fiscal deficit is expected to remain below the 3% ceiling in 2026. But of course, the fuel price freeze is very costly and diverts fiscal resources from critical spending on education, health, infrastructure, to relatively inefficient fuel subsidies. Targeting the energy support on vulnerable households and workers who rely on energy for their livelihoods, for instance, delivery drivers, would shield these critical spending areas while preserving fiscal buffers. And the second priority we highlight is that, as previous speakers said, that Indonesia should strengthen energy security. And one way to do this is to accelerate renewable energy deployment, including, implementing plans to roll out domestic biofuel, which would reduce exposure to external price shocks. Thank you, Laura. I think that's all I have to say on Indonesia.
Thank you, Cyril. Next, we have Jens Arnold, who will speak about Malaysia.
Okay, so for Malaysia, we see resilient growth with some near-term weaknesses, but we also see strong tailwinds from the AI boom and at the same time a widening fiscal deficit. So in the first quarter of 2026, GDP growth actually stalled, reflecting weaker domestic and foreign demand. On a year-on-year basis, growth has moderated to 5.4% with that, which is lower than what we had in the previous quarter. At the same time, the labor market still remains strong, with unemployment actually at an all-time low of 2.9% and the labor force participation still rising. Now, as I said earlier, as a net energy exporter, Malaysia is less affected by global energy prices, but at the same time, it is keeping the fuel price for most consumers constant. So rising fuel subsidies are actually inflating the fiscal deficit. GDP is projected to grow by 4.2% in 2026 and by 4.8% in 2027, largely led by domestic demand and AI-related investments and export. The headline CPI stood at 1.9% in April 2026. Wage increases, higher energy prices, and associated second round effects could generate upward pressures, and the central bank should certainly continue to monitor these developments very carefully. Now, in terms of the policy priorities, our note highlights that Malaysia has room to step up fiscal consolidation to build fiscal space for future spending needs, and that will first and foremost require a gradual phase out of the current energy subsidies. We also see benefits for productivity from reforming restrictive regulations that currently hinder market entry and limit competition, particularly in services sectors. And finally, Malaysia could benefit from investing more into human capital while at the same time addressing the prevalent skill mismatches on its labor market. And with that, back to Laura.
Thank you, Jens. Next, we have Cyril Schwellnus, who will discuss the Philippines.
Thank you, Laura. So the Philippines, in contrast to what you just said about Indonesia, entered the energy crisis already with slowing growth.
Your microphone is down, I believe. It's up.
Okay, sorry.
Yeah, that's better.
So the Philippines entered the energy crisis with growth already slowing. So GDP growth has been slowing over the past year, reaching 2.8% year on year, as you can see here on the slide, which mainly reflects two factors. First, the sharp contraction of public investment following corruption investigations in 2025. And second, private consumption has also been softening even before the energy shock on the back of a weakening labor market. Going forward, we think that high inflation will further weigh on real incomes and private consumption, while the recovery in public investment is expected to remain subdued in the near term in 2026. As a result, we project growth to be weak at 3.2% in 2026, before recovering to 5% in 2027 as inflation dissipates and public investment gradually recovers. Regarding inflation, inflation rose sharply to 7.2% in April, driven by higher energy prices and the depreciation of the currency. Core inflation also increased to 3.9%, suggesting that there are already broader price pressures beyond fuel. The Philippines is highly exposed to the energy shock, as Jens said before, because it imports over half of its energy needs and almost all of its oil consumption. The central bank has already raised the policy rate by 25 basis points, and we expect further tightening as inflation and exchange rate pressures rise. But despite this monetary tightening, inflation is projected to average 6.8% in 2026, so well above the central bank's target band. before gradually easing as energy pressures dissipate and financial conditions tighten. Regarding structural reforms, we highlight two key reforms to boost resilience and growth. First, the Philippines could strengthen energy security and reduce its dependence on imported fossil fuels. This could be done by accelerating investments in renewable energy. As we've seen, there's still a big gap to fill, as Jens showed in a previous slide. And this could also be achieved by upgrading the electricity grid, which would then reduce vulnerability to external price shocks. Second, a key reform would be to revive public investment, which would support growth in the short term, but also boost productivity in the medium term. So here, what needs to be done is to implement reforms to restore public investment execution and to strengthen corruption safeguards in a timely manner, which would support investment both by increasing public outlays, but also by supporting confidence of private investors. Thank you, Laura.
Thank you, Cyril. Now we have Philip Hemmings, who will discuss Thailand.
Hello. As regards Thailand, in terms of economic activity, I think a distinctive feature is that we've seen strong upside surprises in economic growth in the final quarter of 2025 and in the first quarter of this year. And one reason for this has been a surge in exports following the decline in the US tariff from around, I think, 19% to 10%. So that's an interesting example of these tariff effects that we're seeing for Thailand. However, as expected, indicators have since pointed to a slowdown in economic activity. As you can see in the chart here, there's been a fairly large dip in business sentiment. In terms of effects of the Middle East conflict, Thailand has, as elsewhere, experiencing concerns around prices on energy and also fertilizer. And I think perhaps another interesting point is that there is some concern around the supply of plastic pellets, which is used to make food packaging. Overall, for Thailand, we're expecting growth to dip to 1.7% in 2026, but recover to 2.1% in 2027. As regards prices, we're already seeing the effects of the increased energy prices. So inflation was -0.1% in March, and it was 2.9% in annual terms in April. These price increases also reflect the fact that the prices of retail gasoline and diesel are partly shielded by energy subsidies in Thailand, similar to other countries in the region. In terms of policy priorities, echoing what Isabel and Jens said, is that it's important that Thailand tries to keep any measures helping households and businesses to be tightly targeted and time-bound to help contain their fiscal costs. This is important for Thailand because the public debt burden is heading towards the legislated ceiling of 70%. More broadly, Thailand needs to continue working on structural reforms that will strengthen its productivity. And this can be achieved in part by making regulation more conducive to competition. Thank you.
Thank you, Philip. Now we have Jens Arnold, who will present Vietnam.
Okay, so in Vietnam, we see an economy that is still growing at a pace of 7.8% year on year, which is slightly lower than what we've had in previous years, but it's still a very strong and solid growth. But there are also vulnerabilities. 80% of Vietnam's oil imports come from the Middle East, and we've seen as policy reactions tax cuts to shield consumers partly from energy prices. These response measures are much less than what we've seen in some other countries in the region, but they will nonetheless widen the fiscal deficit. GDP growth is projected to slow to 6.5% in 2026 and then 6.2% in 2027 amid higher energy prices and the measures to limit energy use. We see inflation on this chart here, which has risen to 5.5% year on year. And at the same time, fuel and transport prices are much higher, and they have risen to 11.1% by 11.1% in a year-on-year perspective. For the future, we see inflation at 5.2% in 26 and 4.8% in 27, which is considerably higher than the average of roughly 3.5% that we've seen over the last 3 years. In terms of policy priorities, we take the view that tax cuts on fuels in Vietnam should remain time-bound, while at the same time building on the substantial progress that Vietnam has already made with respect to rolling out renewable energy sources. At the same time, monetary authorities will have to closely monitor inflation risks, including the second-round effects that might arise from the higher energy prices, and of course stand ready to tighten monetary policy if that were needed. And that is all for Vietnam. Back to Laura.
Thank you, Jens. At this time, we are going to start our question and answer session. If you're in our audience and you haven't yet had a chance to add your question to the chat, please do so right now. Our first question is dealing with the Philippines. And the question is, with growth expected to slow further while inflation and unemployment remain elevated, are stagflation risks becoming a bigger concern?
Okay, let me answer this. So I think indeed in the near term, in 2026, we see growth slowing quite sharply and inflation increasing quite a bit. And that, would go in the direction of, a stagflationary shock. But we also highlight in our note that we currently expect this to be temporary. So, growth will recover in 2027 to 5%, and inflation is projected to return to the central bank's target band in 2027. So, stagflation is a risk, but that's not our baseline scenario. But of course, the rebound in growth in 2027 and the decline in inflation in 2027, depend on two factors that are really specific to the Philippines. One is that public investment execution is restored so that investment really grows at a higher rate again. And that requires reforms to public investment governance. And second, it depends on inflation receding in 2027. And that will, to some extent, depend on developments in the Middle East, but also on monetary policy. So monetary policy should stay very vigilant and data dependent, and will probably have to further raise interest rates to keep inflation or bring inflation back to target. Thank you.
Thank you. The next question is across countries, and it is, how will the Middle East shock influence semiconductors and tech cycles, especially for the Philippines, Vietnam, and Malaysia?
Okay, shall we start with the Philippines?
Sorry, can you start with another country, please?
Okay, sure. So on Malaysia, I think we see that the tech cycle has had clear positive effects, and in fact, much of that is probably yet to come. For Vietnam, we see to a lower extent similar developments coming up. So we think that overall the tech cycle is a positive force behind growth in at least Malaysia very strongly, and to a lesser extent in Vietnam.
So in the Philippines, what we see is up to now, there has not been very strong positive effects from the tech cycle, which also reflects to some extent the position of the Philippines in the semiconductor value chain, which is more at the back end of packaging and low value added activities. So we do not expect the tech cycle to have a big positive effects going forward.
Maybe let me just add on a general level on the tech cycle. We see certain risks that this tech cycle at least may end or diminish in the coming quarters in case the disruptions of supply chains persist because of the very high energy demand of data centers and other parts of the sector. And of course, if the energy price is very high, this makes investment in this sector a bit less attractive than it was in the past. And this would, of course, then also affect, the countries very heavily involved in the respective supply chains.
Okay. For Thailand, did the forecast include the 400 billion baht loan? So that's the first part. What do you see the growth engine for 2027? And then what is the baseline for the Middle East conflict?
In response to the inclusion of, yes, we have included the economic effects of this loan, which we understand is going to be channeled partly through into households spending, through support to households, but also at perhaps a later stage into investment. So the positive effect from the loan, we imagine coming through in the second half of this year, and maybe more the investment effects coming through in 2027, and that will help contribute to the growth increase in 2027. In terms of the baseline for the conflict, I guess that the Thailand projection reflects, if you like, what we're seeing across, or what we're assuming across our projections for the OECD in terms of the conflict. So we're implicitly seeing some unwinding of this because we're taking the oil price futures, which show a decline in the oil price over time. My colleagues might like to comment on that scenario a bit further.
Yes, that's right. The Thailand numbers reflect essentially, this the first scenario that I was presenting to the global economy, where our oil price assumptions follow the oil price futures, which means that the conflict is resolved reasonably soon, with prices starting to decline from the middle of this year onwards.
Okay, the next one is for Vietnam. The government GDP growth target in 2026 is above 10%. Do you think it is possible? And what should the government do to achieve this target?
Okay, well, we have a growth projection that is somewhat below this target, but we want to highlight that nonetheless, the growth projection that we have for Vietnam is really stellar growth. We see very solid momentum in Vietnam. This is fueled by public investment, part of which is responding to a backlog that we've seen in the past. And overall, there's very strong momentum in the economy. Now, what could Vietnam do to strengthen that growth even further? Here, I think we have in our analysis highlighted two main issues that I want to mention here. One is to strengthen competition in network sectors and in services sectors more widely. We see scope here for making regulations more friendly to competition, also rethinking to some extent the role of state-owned enterprises and leveling the playing field between private companies and those state-owned enterprises. On the other hand, we also think that the functioning of financial markets in Vietnam could be improved, and that is achievable through stronger competition in the banking sector. And the current obstacle to that is the way that monetary policy is conducted. So if Vietnam were to move towards a more price-based monetary policy, where monetary policy transmits through interest rates rather than direct credit growth targets for individual banks, that would allow stronger competition in the banking sector, lead to a better allocation of capital, and hence allow stronger productivity and growth.
So we have a question that focuses on Indonesia and Thailand, and it is, when will Indonesia and Thailand begin to see tangible economic gains from the reforms required for the OECD accession?
Okay, maybe not an easy question to answer here. Of course, much of that depends on the pace of progress of economic reforms. I think there are several topics that OECD work has highlighted. One is to make sure that market forces and competition maintain sufficient strength to achieve a good allocation of resources across the economy, which will then lead to stronger growth. And we've also looked at issues on labor markets. We've also looked at issues with respect to reaping stronger benefits from trade and FDI flows. So there's a lot of analysis and reform recommendations going on, and the more of these recommendations can be implemented, the more and the earlier we would expect some growth dividends resulting from those reforms.
Okay, the next question is on the Philippines. You said that the Central Bank of the Philippines is further tightening its monetary policy. Given the overheating inflation, do you see the Philippine monetary authorities delivering a large 50 BPS hike at its upcoming June policy meeting? Also, how many interest rate hikes do you expect in total through 2027?
Okay, so let me give you a little bit of background on the question of interest hikes in the Philippines. So the central bank obviously faces a trade-off, as Isabel highlighted in her presentation, between growth and that could be weakened through higher interest rates, and inflation that is already very high in the Philippines that could lead that could spill over into, from energy price and food prices into core inflation. So with inflationary pressures becoming very broad-based and then leading to a de-anchoring of inflation expectations. And given that inflation is already very high, and well above the central bank's target band, we do think that the central bank will deliver further monetary tightening over 2026. The balance of risks has shifted really towards high inflation. So we think to prevent these spillover effects into broader price pressures and a de-anchoring of inflation expectations, the central bank will probably, I think as a baseline, our projections will raise the monetary policy rate by another 100 basis points over 2026. I won't go into whether we think they will deliver a 50 basis points increase in June.
Our next question is about Vietnam. Why is Vietnam's growth rate in 2027 declining, while growth in others appear to be rebounding?
Okay, so I think the first thing to note is that growth in Vietnam, even in 2027, is still very strong. We have a slight decline here of 0.3%. This is due to three factors. One is the statistical carryover that we get from the year before, so it to some extent also reflects some weakness in 2026. Then we have a consumption tax increase scheduled for the beginning of 2027 in Vietnam that may dent to some extent what we see with respect to private consumption, at least in the immediate aftermath of that tax increase. And then we currently see in 2026 a strong backlog of public investment that will need to be worked off. And we see that effect more strongly affecting 2026 than 2027.
Okay, this is for the Philippines. Can you please elaborate on the dynamics of private investment? Any evidence of the slowdown as observed for public investment?
So in the Philippines, we see that the slowdown in overall investment, so both public and private outlays, is mainly driven by public investment, by the slowdown in public investment. So public investment, is still contracting in the Philippines. It has been contracting from the second half of 2025. So that's the main driver of the slowdown in investment. But of course, that has spillover effects on private investment as well through business confidence. And so going forward, what we expect is a gradual recovery in public investment, but with public investment remaining below the level it had reached in the first half of 2025 until more or less the first half of 2027. So only in 2027 will public investment recover to the level it had reached in the first half of 2025. Private investment will recover as well in 2027, but of course, in the very near term, we expect monetary tightening to also have an effect or a downward effect on private investment in 2026.
And with that, I would like to thank our audience for joining us today. And we will try to answer any questions that were in the chat that we didn't get to by email. But thank you very much. Have a wonderful day.
Thank you, everyone. Bye.
Thank you. Bye-bye.
Thank you.
Thank you. Bye-bye.